Want to transform your investment portfolio from $0 to $100,000? In this video, I'll be revealing the exact strategies that can make that leap a reality. If I can do it and I'm just 24 years old, you can absolutely do it too if you grind, rise and shine, put your mind to it. Even if you've never invested a dime, I'll guide you through the proven long-term investment techniques that deliver real results. No Forex or day trading involved in this one, guys, and you definitely don't need a fortune to get started. This video is perfect for anybody ready to build their net worth with a solid data-driven strategy approach. And let me hit you with this hard truth here. Did you know that the average American has only around $5,300 in savings? A study by the Federal Reserve found that 40% of Americans would struggle to cover a $400 emergency expense without borrowing or selling something. That same survey found nearly that 25% of Americans have no retirement savings at all, while those who do have an average saved of about $65,000. That is a crazy difference here. It's time to change that narrative together. And trust me, it's not as hard as you think. There's a quote that will be key throughout this video, so listen up in your investment journey. John Bogle, the founder of the Vanguard Group, famously said, "Time is your friend. Impulse is your enemy." Today, you'll find out how time can truly be your greatest ally, while acting on impulse can drag you down to a place that complicates your life significantly. So, let's get right into it. I'm sure you've come across a ton of myths about investing that can leave you feeling very much uneasy. You might have heard things like, you need a lot of money to start, or investing is just gambling, or even investing is just for rich people. Wrong. This is wrong. These are misconceptions designed to intimidate you and make investing seem like this very complicated game meant for the super rich and the financially savvy. The truth is, you don't need a hefty sum to begin investing, and with all the apps and platforms out there, you can start investing with just a few bucks. Way less than your overpriced coffee. I'm sorry to call you out on this one. For me, it's boba or matcha, so I understand. Many investors started with little to no knowledge, and they learned as they went. You don't have to know everything before you dive in. Start small, build your confidence, and gain knowledge over time. As a beginner investor, the idea of investing in stocks can seem very daunting and very overwhelming. Where do you even start? So one of the most crucial steps for beginners embarking in their stock investing journey is to set clear investment goals. What do I mean by this? Well, without defined objectives, it's very easy to make impulsive decisions or chase unrealistic returns, which is gonna lead to disappointment and a lot of financial setbacks. And if you're somebody who normally just picks up something without having a checklist, you're gonna wanna listen up even more. First and foremost, you need to define your financial objectives. Are you investing for long-term growth with the aim of building a substantial nest egg for your future? Maybe you're just looking to simply grow your net worth over time. That's totally cool too. Or maybe you just don't want to be tied down to your 9 to 5 anymore and actually want to start growing your wealth without having to show up every single day to something that you might not be very passionate about. All the above is possible with the right investment strategy. So let's break down what this timeline looks like actually building a $100,000 portfolio. You may have heard that reaching that first $100,000 is the hardest milestone to hit, but once you get there, everything else tends to flow more smoothly. So let's say you start investing $1,000 a month and you expect an average annual return of about 8% from the market. Guys, that is totally reasonable. And as a matter of fact, it's been happening for the past, 100-something years. With this plan, your journey to your first $100,000 would take approximately 6 years. Now, here's where it gets very exciting, or what I would call priceless. Once you hit that $100,000 mark and continue investing, your next $100,000 would only take about 4 years to accumulate. This is where that magic of compound interest really starts to work in your favor. Think about it. After reaching that first milestone, you've built that solid foundation. Your investments have more time to grow, and the power of compound interest is kicking in. I love Albert Einstein, who once said, "Compound interest is the eighth wonder of the world." My guy, my guy. That means that your money is not just sitting there. Yeah, actually, it's working for you while you sleep, earning returns on top of returns. This is not bogus. This is a real deal type of thing. This illustrates the point that while building that initial $100,000 nest egg can be challenging, it's absolutely doable with discipline and consistency. It's gonna require commitment, but once you get past that hurdle, you're gonna find that your investments start to grow exponentially. So while your first 100,000 might feel like a big mountain to climb, once you do reach that summit, you're gonna have the momentum and knowledge to keep pushing you forward to eventually make your first million. And that's a route that I am on too. So if you're on that route, make sure to subscribe below and let's hit that journey together. Okay, so now that you have your roadmap, how can you actually make this happen? So a little story time. In my early investing days, I had no clear goals whatsoever. I was just buying stocks based on trends. At the time, it was marijuana trends, I'm not gonna lie. It wasn't until I set specific goals for what I want my financial future to look like, I saw significant progress in my portfolio. Having those goals kept me focused and disciplined. This brings me to a very crucial point here. It's essential to determine your risk tolerance and why you are investing in the first place. Investing in stocks comes with inherent risk, and how well you can handle market fluctuations is going to significantly impact your investment strategy. If your risk tolerance is on the lower side, you might prefer a more conservative approach that focuses on ETFs or exchange traded funds and index funds. And you might be asking, Tay, what's the difference here? Well, ETFs are like baskets of different assets that you can trade on the stock exchange, similar to individual stocks. They offer diversification because they often contain multiple stocks, which can help reduce your risk. You can buy and sell ETFs just like any other stock. Now, index funds, on the other hand, are mutual funds designed to track a specific index, like you might have heard the S&P 500. They typically have lower fees than actively managed funds and are less flexible than ETFs. Now, if you have a higher risk tolerance and a longer investment horizon, you might feel more comfortable building a more aggressive portfolio that leans towards individual stocks. Investing in individual stocks means buying shares of specific companies. Think Apple, Google, Tesla, Microsoft. This approach can have higher returns if you pick the right companies, but it also comes with increased risk since you're spreading your investment across multiple assets. So it's essential to do your research here and choose stocks that align with your investment goals and risk tolerance. And if you want a specific video on how to do so, let me know in the comments and I'll be super freaking pumped to create that video just for you. Laying out your goals with specific target amounts can also help you track your progress and make necessary pivots along the way. So for instance, if you're saving for retirement, determine how much you need to accumulate based on the lifestyle you envision for yourself within retirement. And we have a super cool tool to help you figure out that number. Tay don't play around here. So just head over to pricelesstay.com/retirement to find out exactly how much money you'll need to stop working. By setting clear investment goals, understanding your risk tolerance, and defining your investment budget, you're laying a solid foundation for your stock journey. You also might be wondering, Tay, I understand that I need to set goals, establish my risk tolerance, but what actually should I invest in? All right, we're gonna break it down, explore some solid options that can help you build that strong investment portfolio. First up, ETFs. SPY. This is the most recognized ETF tracking the performance of the S&P 500 index. It's a great way to gain exposure to the top 500 companies in the United States market without having to actually invest in an individual 500 companies. You just buy one thing and boom, now you have 500 things. All right, QQQ, another popular one. If technology really excites you, QQQ is an excellent choice. It tracks the NASDAQ 100 index, which includes 100 of the largest non-financial companies on the NASDAQ, including giants like Apple and Amazon, the ones that you know. All right, VTI, I love Vanguard. For a comprehensive approach, VTI offers exposure to the entire US stock market. This means you get a mix of large, mid, and small cap companies all in one fund. Another Vanguard one that I like, VOO, similar to SPY, VOO or VOO aims to replicate the performance of the S&P 500, focusing on the largest publicly traded companies in the United States, and it's just a great option for those looking for stability and growth. Next, let's jump quickly into index funds. So VFIAX. This fund also tracks the S&P 500 and it's a reliable choice for investors seeking broad market exposure. Then we have Fidelity's similar type of thing, VXAIX. This fund aims to replicate the performance again of the S&P 500 index, making it a very solid option for your investment strategy. Schwab, once again, all the big guys, they have very similar index funds. That's SWPPX. It's a very strong contender that provides low expense ratios and extensive exposure to the US stock market. And while all ETFs and index funds may come with a higher price tag compared to individual stocks like VOO at $350 per share, there's no need to worry here. This is where fractional investing comes into play. With fractional investing, you don't have to purchase a whole share for $350. So for instance, with $100, you can invest in VOO and own about 0.29 shares. This basically allows you to benefit from diversification without requiring a significant upfront investment. It's like taking a bite out of a slice of pizza and not having the capacity to eat the whole thing for whatever reason. You're full, you don't like it, whatever it might be. Fractional investing makes it very accessible for everybody to begin their investment journey regardless of their budget. Instead of being deterred by very high price tags, you can actually gradually build your portfolio and take advantage of those potential returns. Dollar cost averaging is another, probably my most favorite, powerful strategy to consider here. This involves investing a fixed amount of money at regular intervals, monthly or weekly, regardless of market conditions. By consistently investing over time, you can mitigate the impacts of market upturns, downturns, and take advantage of lower prices during those market downturns. And this is why I like DCAing all the way. So an investment of $100 per month over a period of 30 years with an average annual return of around 10% would pretty much grow to $225,000 due to the power of compounding and dollar cost averaging. Consistency is your friend. Impulse is your enemy. Another thing to keep in mind is to avoid the temptation of trying to time the market. I wish I knew this sooner. Many investors believe they can buy low and sell high, but even the most experienced investors find it challenging to predict the market movements consistently. Instead, focus on a long-term investment strategy and stick to your plan. So let's do a little demonstration here. We have two investors, Sarah and Sam. Sarah tries to time her investments based on her emotions and market movements. She feels anxious when the stock price is high and more confident when the stock price is low. Here's how her investments look over the next 6 months. Sam takes a very much different approach, very disciplined, invests $1,000 each month without trying to time the market, following this approach we call dollar cost averaging or DCAing. Investors like Sarah often buy stocks when prices are low out of FOMO and may avoid investing when prices are high due to anxiety. For instance, she might invest that $1,000 when a stock drops from $20 to $15, but refrains, takes a step back from investing when the price rises to $25, missing out on the potential gains as the stock continues to climb. In contrast, investors like Sam invest a fixed amount, say $1,000 every single month, regardless of where the stock price fluctuates. This method allows him to purchase more shares when prices are low and fewer when prices are high, leading to an average purchase price that smooths out volatility over time. For example, if the stock price varies between $15 and $25, Sam's consistently investing, ensuring he benefits from both lows and high, meaning his average is about $20 or so dollars. Emotional investing can lead to missed opportunities and lower portfolio values due to impulsive decisions, while dollar cost averaging fosters this disciplined investment approach that leverages market fluctuations to build wealth over time. The truth is, studies have shown that investors who regularly monitor their accounts and make frequent trades often underperform compared to those who take a more hands-off approach. So do less. Do less here, not do more. Fact checking here too, research shows that nearly 80% of individual investors who attempt to time the market underperform the market average, but investors who regularly contribute to their portfolios, such as through dollar cost averaging, tend to achieve better long-term returns by avoiding the pitfalls of market timing and benefiting from consistent investment growth. So whether you choose the index fund, ETF, or individual stock route, the next crucial step is selecting the right investment vehicle to achieve your goals. With tons of options out there, navigating the different account types and investment platforms can feel overwhelming, but making informed decisions at this stage can significantly impact your long-term success as an investor. Let me take you back to when I first dipped my toes into investing. I opened up a brokerage account under my parents' E-Trade account. Well, it served its purpose at the time. Looking back at it, I realized that there were many other options that might have been more beneficial if I had done more research. A popular choice for many investors is a traditional brokerage account. And these accounts, while they're not necessarily bad, they offer a wide range of investment options, including individual stocks, bonds, mutual funds, and ETFs. Keep in mind that brokerage accounts are typically taxable though, meaning you're gonna owe taxes on any capital gains or dividends earned. While this might deter some people, the returns you can generate in the stock market often outweigh these tax implications. After all, investing is one of the most effective ways to combat the current rate of inflation and make your net worth grow. When I first opened up my brokerage account, I remember this feeling of excitement and a little bit of anxiety, I'm not gonna lie. It was a significant step into the world of investing. Choosing a reputable brokerage firm with commission-free trading is key. Opt for a brokerage with a user-friendly online platform and a mobile app in these days for easy account management and on-the-go investing. It's also beneficial to select firms that offer research tools, analysis tools, along with educational resources to support your investment decisions as a beginner. It's very important. Once you identified a brokerage that meets your needs and criteria, the account opening process is very straightforward. You're gonna need to provide some personal information, such as your name, your address, if you're in the United States, social security number, as well as details about your investment objectives, risk tolerance, and financial situation. Oh, don't forget to compare account fees, trading commissions, and investment minimums across different brokers to find the most effective option for your needs. Look for brokers that are gonna offer commission-free trading on certain investments like ETFs to help minimize those costs as you build your portfolio up. To explore my favorite brokerage account, head over to pricelesstay.com/brokerage for my personal fave. Now, after completing the application process, you'll need to fund your account with the desired amount of money. It's important to take note here that some brokerage firms may require a minimum deposit. So before you even go and open one, review the requirement so that you can, start investing once you get approved for this account. And once your account is actually funded, you'll have access to a wide range of investment options and tools to help you manage your portfolio. Remember, opening up a brokerage account is just the first step. You actually have to go and start investing into things. It's essential to continue educating yourself and making adjustments as needed to make sure your portfolio remains aligned with your long-term goals. Once you've built your investment portfolio, it doesn't stop there. Remember, you got to monitor and rebalance it regularly to ensure it aligns with your goals and risk tolerance. I used to pretty much check my investment account daily, several times a day, and sometimes it would get me stressed over the market fluctuations. And eventually I learned that less frequent monitoring led to better decision making and less stress. Rebalancing involves adjusting your portfolio to maintain your desired asset allocation. And by the way, studies have shown that investors who look at their accounts every few months outperform those who check daily. This is because less frequent monitoring reduces emotional trading decisions and allows you to have this long-term perspective. Investing is a journey and there's always more to learn. And when I first started investing, I spent a lot of time reading books. This is where I came up with the Kindle Audible narration times 2 speed, my hack to speed learning. One of my favorite books back then was The Intelligent Investor by Benjamin Graham, and it taught me really the importance of value investing and staying disciplined in my approach. Remember, knowledge is power, and the more you learn, the more confident and successful you can become as an investor. The best time to plant a tree was 20 years ago. The second best time is now. And by taking action today, you'll lay the groundwork for a brighter financial future. Be sure to check the description for all the links mentioned in this video. Thank you so much for watching, Priceless Peeps, and I'll catch you in the next one. Peace.